Good afternoon. Good afternoon, everyone, and welcome to the 2024 CARW Economic and Commercial Real Estate Outlook. We appreciate the sponsorship and support from Coldwell Commercial and Rock County for this special event. And we're grateful to our annual sponsors this year for their partnership in our 30th year as an organization, for our nearly 1,000 members, and for our industry of commercial real estate throughout Wisconsin. 2024 is off to an interesting start. A word that I handpicked during our annual meeting in October to describe the coming year. For some, it's been interesting as to say record-breaking. For others, interesting as presenting detours. And for our members in winter services, I'm sure it's been an interesting year as well, as we're gathered here today on nearly a 50-degree day in February. How unexpected. Well, we're off to an interesting start in the year economically as well, which we'll hear more about today, as we continue to wait for interest rate adjustments as inflation appears to be easing. We're all watching as we anticipate $2.2 trillion worth of real estate debt coming due by 2028. And I'm sure you're monitoring construction costs, which are starting to show signs of relief. While we await new development and redevelopment in asset classes while vacancies at historic lows, one thing is certain, and that's that our base of commercial real estate members as a part of CARW are ready for the challenge. We have professionals in every aspect and category of commercial real estate, and we're up for the challenge as we've overcome challenges in the past, and we'll be sure to see an exciting future in 2024. We're honored to have with us today Jim Costello, Executive Director for MSCI Research. Jim co-heads the Real Estate Asset Research Team with responsibility for the Americas. He is the principal author of Capital Markets Research and a frequent speaker at industry events. At Real Capital Analytics, which MCSI acquired in 2021, Jim was a leader for U.S. research. He spent 2 decades at Toronto Wheaton Research working on issues of real estate risk and forecasting. Jim is a member of the Counselors of Real Estate and served a term as a member of the Commercial Board of Governors of the Mortgage Bankers Association. Jim will speak for about an hour and has time for a few questions following his presentation. Jim, welcome and thank you.
No feedback. Awesome. Hi, I'm Jim. Thanks so much for having me here. I'm excited to be here. I love seeing different cities. My only regret on this trip is that then I got to jump over to Madison quickly to see clients tomorrow. I didn't have time just to kind of flaneur around the city and walk around because I had calls that would pop up in the morning. That's what happens in the business world. You know, people are calling from other parts of the world. But that's one of the things I really enjoy, just going and seeing a city and seeing just the physical layout and what's different in this place versus others. And that's the one thing I did take away from this is a neat hotel. It makes sense, you know, near the sporting center and everything. Sure, the basketball teams are going to want someplace nice, but this has been pretty cool. But it's giving me just a little taste that I got to come back here. But I'm here today to talk about issues in what's happening in the commercial property markets. It's kind of timely. We just finished analyzing what's happened in 2023, and everybody knows it was a down market. Activity wasn't so strong across the U.S. There's really kind of 4 parts of what I'm going to talk about today. I'm going to talk first about that issue, about just where we were in 2023, and give first sort of a national perspective on what's happened with deal volume and investment activity. And then I'm going to make some comparisons to how Milwaukee in particular compares to the national trends. Now, everyone in the room is going to know a lot more about deals and prices of assets in Milwaukee than I will. But it's helpful, I think, just to provide that perspective and talk about sort of where the market stands. And then we're going to get into issues of pricing. It's been a big topic. Everyone's worried about commercial real estate prices and how they're changing. And one of the key things that I keep stressing to folks again and again and again, not everything is an office building. Prices aren't the same everywhere. It's commercial real estate as an asset class. You have unique trends and unique performance characteristics. It's not as bad as everything happening in, say, coastal markets with the CBD office buildings. There are some bright spots out there. And even though there's some bright spots, there's still some distress, and that's the next thing you get into. It's almost a thing a lot of folks are almost rooting for. You know, they're almost hopeful that there's going to be a lot of distress. They can get in on a lot of those deals on the repricing. And there's some elements I think that will be interesting there. But I think, you know, it gets into a theme that I've been stressing a lot in my talks. Every downturn is not the same. What happened in the last downturn doesn't necessarily translate into the current downturn. So you have to kind of be really deliberative in what you're looking at there. And then I'm going to close talking about some thoughts just moving forward, kind of wrapping it up on some of the broader economic drivers that relate to each of those issues, and provide some thoughts on a forward-looking basis there. So anyway, where are we for the year? What happened? Growth in deal volume fell at a rate in 2023 that was almost like that seen during the aftermath of the global financial crisis. Okay, you can kind of see this here. The gray bar here, this is the sales, this is the growth rate for sales of commercial properties. And this is everything: offices, industrial, apartments, retail, hotel, even development sites, down at these double-digit rates. And you know, people see that double-digit decline and that it's approaching the levels we saw in the financial crisis. And then all the Chicken Littles come out. Hey, the sky's falling. Everything's bad. It's just like the financial crisis. We all got to worry. You know, you see those growth rates. And it's just troubling. But I'm not sure it was everything, though. And I'll show that in a second. But it is certainly the case that every property sector hit that. I'm looking at just a table here. This is probably not helpful for a presentation, but it's helpful later if you want to look at the slides. But just sort of every property sector, where the deal volume was. And in the column right here under 2023 for the year in total, you see a lot of big negatives. A lot of double-digit declines in deal volume for the year. Again, that's one of those things that, you know, Chicken Little is out there saying, hey, it's the end of the world, double-digit declines. Even industrial's falling. This isn't good. But I think part of it is that we're sort of in a rubber band economy. You know, we sent everybody home to sit on the couches for 6 months in 2020, and then started to open things up again. And the economy has been going through this back and forth ever since. You just don't turn the spigot back on immediately, like turning on a cold water faucet and expecting everything to be fine. We're still dealing with the after effects of that shock, putting everybody, you know, out of the active economy for a bit. And we can see some of that with prices. Shown here, just growth in property prices. Each one of these lines, each color is a different property type. And we have, again, kind of double-digit declines, almost as bad in some cases what we saw in the financial crisis. But here's where you see the rubber band. It's a big decline, but it was a big increase in 2021, 2022. Again, we put everybody at home, we throw interest rates to record low levels, investors are hungry for some kind of yield, so prices surge. Interest rates go up, and now prices come back down, but it's that zig and zag back and forth. So people are really focused on this, the big negatives here. But if they don't think about that relative to what happened before, in the excess that we went through in 21 and 22, then they're only taking part of the picture. It's not as bad as sort of that growth rate for the year plus. You kind of see this in the levels of deal volume, not the growth rates. What I'm looking at here is just the quarterly sales for commercial property across the U.S. And there's usually a seasonal pattern. I think we're all aware of, like, in the fourth quarter. Fourth quarter is usually the busiest quarter, right? Everybody's trying to get stuff done before the end of the year, get that last deal closed, get that last commitment in place. Typically, the fourth quarter is the strongest quarter of the year. So there's some seasonal variation. But 2023 was kind of a weak fourth quarter. We didn't see that spike at the end. And that had a lot of people concerned. I'll talk about that in a bit. But the key thing is what happened in 21 and 22. Those are record high levels of deal volume. You know, we've never seen so much trade ever. And so the slowdown we're seeing now is, to some degree, just a function of kind of catch up. In the fourth quarter of every year, this orange line here, for the period from 2015 to 2019, it was around 160 billion every year, in that pre-pandemic period. So we're down maybe 30% from that previous peak, not the 50% year over year from those excess highs. So, hey, 33% decline, that's not healthy, that's not good, but it's a lot better than 50% decline. So it's not as bad as those headline figures really kind of make it out to look. If we look at some key Midwestern markets, the picture for everyone here is a lot better. If we look at the Milwaukee and Chicago, Detroit, same kind of declines nationally and same kind of declines relative to the pre-pandemic trends. But Milwaukee outperforms. So you got that going for you. The deal volume actually grew for the year. And so that's an unusual story compared to other markets. Now, I took a look, I didn't include every Midwestern market. There's not a lot of markets that have this kind of activity. I mean, it's not just like a small market kind of issue. If you look at like St. Louis as well, or Columbus, I wasn't trying to discriminate against other Midwestern markets. I'm from Chicago originally, even though I live in New York now. But it's just, you had a couple things where Milwaukee was able to outperform the rest of the Midwest. And in fact, that seasonal pattern I was talking about, you didn't have that here. You didn't have that weak fourth quarter that the rest of the country did. There's that same kind of concept, just quarterly deal volume. And on average, you saw around 442 million for every fourth quarter in that pre-pandemic period. But this last year, up to almost 600 million. But it fit that normal pattern of more activity in the fourth quarter than at any other point in the year. So, other parts of the country, it's still lagging a bit, still dealing with some of the after effects of COVID, but you've kind of gotten a bit of a rebound back to the previous patterns that were around before COVID. So, for Milwaukee in particular, the office sector was really the thing that helped drive this. And from that first table I showed, this is very different. Office is still suffering nationally. You don't have the tremendous pace of office sales. I mean, it's at record low levels. But here, you're doing a bit better. It's not, and I dug into this, just looking at the individual deals, and again, I bet all of you here would know those individual deals better than me. It wasn't like one building that drove it. It wasn't like one investor or one big story. It was kind of spread out, which in some ways is healthier. The one thing I saw that makes it stand out a bit, see, there were a few deals where it was a corporation selling into our world, our investor and manager world. And so the motivations there could be a little bit different than everyone here, where you're talking about lease rates and cap rates and investment returns. To them, it's just, hey, it's not an investment, it's just a piece of hardware we use to run the business. We don't need it for this business anymore. So maybe it's a little bit overweighted to that, which is kind of related to just the industrial structure of the region. But nonetheless, deal volume is deal volume. And the money flow is money flow. And the office sector, it did help. So nationally, if we look at the top markets for 2023, in any normal period before the pandemic, there were two markets in the world. It was Central London and Manhattan and everything else. And whenever we did rankings of the top markets in the United States, it was always difficult because you'd have to talk about everything except Manhattan because Manhattan was always at the top. And that has not been the case since the pandemic hit. The two markets that have been kind of trading the top positions are Los Angeles and Dallas. Typically those, Dallas coming out on the top. And there's a couple reasons for this. One, it's the weakness of Manhattan. You don't have the office sales. That's why I thought the Milwaukee story was so interesting, because you had office sales. But Manhattan, just the market in the past was all these $1 billion plus office towers. Investors aren't buying those as much anymore. And so the market just can't get into the rankings the way it had. But investors are pivoting out of those high CapEx to NOI type assets into things that they view as more safe and more predictable, like industrial and apartments. And those two kind of sprawling, heavily exposed to logistics, operations markets of Dallas and LA, that's why they've been getting up to the top. Because investors are trying to focus on those assets. Now, this is the top 20 markets. I took a look. Milwaukee would have been at number 55 for the year. So, that's better than 200. But it was actually up from a year before. So that growth did propel Milwaukee in sort of the rankings nationally. Now, in terms of the kind of money flowing into the commercial real estate world right now, it's a little bit different than the past. Take a look here at the net flows of different types of investors. You have your private capital, like family office, just wealthy individuals buying stuff, your Mark Cubans of the world. Institutional money, groups like PGIM, AEW, CBRE and LaSalle Investment Management. That institutional money, representing pension funds. You have the public money, the REITs, and then like the big cross-border investors. The chart on the right here, I'm showing sort of the net acquisition trends for 2023 in total. And the two groups that were buying were cross-border investors and private. That, like private, bought about 1.3% more than they sold last year. So they were adding to their portfolios. Everyone else, on a net basis, typical institutional money and the REITs, they were just selling more than they were buying in total. That's in total. When you look at individual sectors, it's a little bit of a different story. The institutions, they're pulling back. They're the ones that, for a lot of things in our industry, that's a sign of where the market is. They pull back in total, but it's really, they're over here in this orange. They pull back in retail, senior housing, they're pulling back in office. But they're doing some apartment, they're doing some dev site, they're doing industrial. It's private though. Private is the big buyer for other things. Like the office sector, to the extent there's deal volume, a lot of it is still private. And the reason I find that important, because private is typically the type of investors there. It's people who are more in tune with their local market. Like I noted, I like to visit cities and see things. What I used to do before I hurt my Achilles, and then I hurt my knee. I just keep hurting stuff. I love doing these talks and then like go out in the morning for a run and do like 4 miles quickly. Not the fastest 4 miles anybody ever ran, but I get to see a few things in the city. And I still would never develop the same intimate knowledge of the private local investors who just know that city inside out. It's their own money, they're taking risks, but they do these things before the rest of the market does. And they're starting to put money to work. So I think that's maybe an early interesting indicator for certain sectors that they're starting to step up and buy things when others are still a little too fearful. I mean, institutional money is always going to be backward looking. If you are investing money on the behalf of SWIB or CalPERS, the worst thing you can do is get in too early and have your fund not deliver the returns that you promised, because then there's not that next fund, because they're not going to go back to you. So they worry about that reputational risk. They're always a little bit slow and not jumping into the market the same way. So they're going to try and wait and see what happens with pricing first before they do anything. So on that, I'm going to jump into pricing. The cap rates are going up. Now this is a story that everybody is familiar with. The question that everyone has had is just how much are they going up in line with the interest rate increases? Again, it's that rubber band economy, 2021, 2022, interest rates were 0.5%, and cap rates followed. Now they don't move in a one-to-one kind of framework. You know, cap rates move based on interest rate movements, sure, but then you also underwrite other things like the amount of income you're going to get and just some other risk factors. So it all didn't move the same way, but it all kind of rhymed in that low rate environment. But the rebound afterwards has been interesting. There's been a divergence. If we look at the industrial and the apartment sector, that's the teal here and the orange. We're both kind of back to where they were before the pandemic. Maybe a little bit lower for industrial. So it's almost as if, you know, the sectors were, okay, we were in this bubble period when rates were low. We're back to the fundamentals that drove us before, and we can reset from there and go. As opposed to these sectors where investors where investors are coming to the realization that the capex and some of the uncertainty just makes it harder to do. Like the office sector, you're well above now, on average nationally, well above where you were, that's a blue, from that pre-pandemic period. It's just not as easy to do office investments today. It's just not as easy to underwrite that because there's still so much uncertainty about what happens next on the tenant side and the use of space. And I have some thoughts on that at the closing. I still think there's a need for office space. There's a need for people to get together and talk like this. You couldn't really do this on Zoom today. We could, but then it'd be messy and loud. You wouldn't really get a chance to really socialize with folks and get the sense of where that next deal is coming from. So there's still a need for people to be together, and I think offices will survive, just not in the same way as before. In any case, that was cap rates, and that was a movement there. But the deal volume is still low because it hasn't adjusted enough. You know, if you want to sell your building today, if you try and sell it and you're asking for $1,000 a square foot, maybe you get a small pool of potential bidders who are interested. Reduce that to $500 a square foot, you're going to get a much bigger pool. Reduce it to $50 a square foot, you're going to get a really big pool of folks, right? It's sort of that difference between where buyers want to be and where sellers want to be. So deal volume's down in part because prices haven't adjusted enough. It hasn't adjusted to a market clearing price. So I was talking with some professors at MIT, and I thought, okay, can't we kind of map out what that revealed preference would be between where buyers are and how much prices need to move for the market to clear? So we came up with an index that just maps that difference between where buyers are and where the sellers want them to be to get the market to clear. And so you can see here, again, same colors for every property type. We had a big decline for hotels in the immediate aftermath of the pandemic. Hotels they suffered a double whammy. There was a credit market crunch in hotels that happened even before the pandemic. There's some oversupply, everyone was worried about it. You don't have to take a picture of that, you can get this later. It's not gonna look very good here. You can get the slides later. It's just, it'll be all fuzzy. Unless you're trying to get a picture of me, then go away. Then go ahead. So, but in any case, that gap, you don't need as much of a discount to get that kind of immediate market liquidity for the industrial market. There's not the same level of deal volume we had a year ago, but it's still a healthy level. As opposed to the office market, right now, we're seeing a gap between where buyers want to be and where sellers are of like 19% for CBD office buildings. And so I took that kind of market clearing measure and I made a liquidity adjusted version of price levels for the office market. Now the blue line here, that is our office price measure for CBD buildings and suburban buildings. This is national. But the blue line is made from a process where we kind of take every deal and we look at, on a same store basis, how that transaction has moved from last time that building sold. So we're kind of controlling for quality differences there. And it's showing kind of the true trend in what sells in the marketplace. But then the orange line, that's that liquidity adjusted version, which is almost kind of like what you'd see if you had kind of REIT-like pricing, where it's just whatever happens to sell today because somebody had to sell some stock today. That's sort of like if I want to get that immediate price change, that immediate deal closing, how much of a price change do I need to meet where the buyers are? So for this liquidity adjusted version for CBD offices, peak to trough, we're looking at a 50% decline in asset values, nationally. It's heavily weighted to the big coastal markets. When the market was so frothy in 2015, 2016, 2017 for places like Manhattan, you had Chinese investors coming in, buying assets, not based on the IRR they were going to get. They were buying assets more on a capital preservation play, diversifying their holdings outside of one country into other countries, into countries with greater protections around the safety of their investments. I'll just say that so I don't get in trouble. But the price declines are pretty intense for these big CBD offices, and they're still not clearing at a high level, which suggests that there's even more price declines that may be needed if that market doesn't get back to a high level of performance. Suburban prices, they're down. They're not down as much. They're still illiquid, but the degree of illiquidity is not as great. So that creates this dynamic where if a market has just historically more deal volume in the suburbs anyway, then you just don't have as much of a challenge out there. And this is something I think is getting lost in sort of national attention to problems of the office market, in part because there's a New York bias. I live in New York. You know, I talk to people there. The reporters at the Wall Street Journal, I know them all personally because we live in the same neighborhoods. But Peter and Conrad at the Journal, they look at what happens in New York and they think that that's just the rest of the world, and it's not. And I'm not just bad-mouthing them without them being around. They're friends. I tell them that when they're around, but that's what sells newspapers. So there's that aspect too. But anything that's a little bit more suburban focused, the market is not as disjointed. There's a little bit more liquidity. Public and private pricing has been an issue. And I was talking earlier about sort of some hopeful signs that maybe a few things have changed. The public markets are giving me a little bit of hope. So we have in the blue, rather the orange, that's that same store price index for private assets, for just the sale of a building. I'm looking here at the office sector, the industrial sector, and the retail sector. The blue, though, the company that I'm with, it's MSCI, they bought the company I was with, Real Capital Analytics. They bought them for $1 billion back in 2021. And it, for me, it was cool because suddenly we're around all these really thoughtful people working with all this public equity data, tons of computer power. I mean, they look at our database and they go, that's cute. A few billion of deals. Every minute that kind of information flows through the bond markets. But we talked with them. We have an index there now that tracks the performance of REITs in the US by property type. And then I took the price component for those REITs, and that's the blue line in these. You see a lot more volatility because the volatility comes from the stock market to some degree. But the performance there has been interesting relative to the other property, the private asset version of the world. And number one, the immediate aftermath of COVID See here for the office sector, private valuation of assets just kind of skated through it. It's like the office investors were saying, sure, there's some dislocation today. People aren't coming into the office. Something's happening. We're going to wait and see before we take a loss. As opposed to someone who had some REIT shares, just had to get out temporarily to do something else, that actually declined. So there's that mark-to-market version, and there's the mark-to-maturity version of sort of the private asset world. And that was a short enough window that people were able to hold on and not sell at a loss because they were getting support from federal authorities. We had the CARW Act coming in very quickly. We had every central bank in the world flooding the markets with capital. So you didn't have to take a loss. They were trying to prevent, big sell-offs and prevent capital losses. As opposed to today. Today, we now have every central bank in the world going the opposite direction. We have less of that stimulus stuff happening. And so you don't have those supports. So the prices have been falling for assets because now people realize that they have to take a loss. The thing is, you look at the REITs and where the REITs are, they're already ahead of that. You look at the office market even, and there's been an uptick since late 2023. Retail, it's been kind of flat, but it's up a little bit through there. And industrial, it's down from the peaks in 2021. I think people were a little too optimistic about industrial then. But even there, they've shrugged off the interest rate increases because they're anticipating that rates are going to be coming down in the future. When I talk to our fixed income research colleagues, and they show me the forward curve on SOFR, there is an expectation that rates come down. That's something that everybody kind of understands is going to happen. I think the debate is around just how much and how soon. And that's where I think there's a little bit of noise. Like when at the CREFC conference, sometimes I think people were a little bit naive in terms of their expectation of just how low rates would go again, thinking that, well, once we get through this, we'll go back to where we were before the pandemic, right? And we'll go back to the low interest rate environment that we saw. I think part of the issue there is that in our industry, right now I think folks are too young. It's just that we don't have enough history for folks. Many folks, just looking at this room, I bet many of you folks came into our industry after the global financial crisis. Many of you, your careers have only been set in this period of free money when the central banks were always putting the accelerator on. And as they're withdrawing that and trying to get back to some sort of normal level, the chance of kind of getting back to those low rates is my fixed income folks tell me that it's a lot lower than some of the folks maybe talking their book in the real estate world we're talking about. But I've got some closing thoughts on that, but I want to talk just the REIT world. They've also got an advantage at the moment on a financing side. If I looking here at mortgage rates for commercial properties, kind of a benchmark 7 and 10 year fixed rate series we publish. Traditionally, it's been kind of close to BAA corporate bond rates, which is kind of close to what the REITs can borrow at because they can issue a corporate bond. Corporate bond markets are starting flat. Corporate bond markets are anticipating, lower rates in the future. And REITs right now have an ability to finance at a lower rate than any institutional investor. So even though they weren't big net buyers last year, I wouldn't be surprised if they became net buyers this year because they have a lower cost of capital than other big buyers in the market, and it could potentially end up as accretive for them this year. So if you're looking to sell something this year, talk to those REITs. They may have a little bit more dry powder to put to work. But in terms of how prices have evolved in Milwaukee versus the rest of the country, we've got two things here. The blue line, this is the office sector, and the blue line is the U.S. in total. And again, this is office in total, CBD and suburban. but it's down sharply. This chart kind of minimizes the impact of the price declines for Milwaukee because I'm showing on a price per square foot basis, and prices are lower in Milwaukee. We do one of these indexes for Milwaukee where we're controlling for the quality differences of buildings. I just thought I'd throw this green dotted line, the green, I figured, hey, the bucks, so kind of take the colors, is just the individual deals that are out there, but we statistically control for the quality differences of every building to say, well, this one sold at a higher price because of the tenant and the term, and this one is a lower price because it's older, it's got some CapEx issues to address. And so we control for all that. It's kind of like an ABM system without being ABM. And then we show just sort of the trend. Now, from the peak, we're showing that prices are down 8% for what's transacting. Again, if we do the liquidity adjusted version, it would probably be even lower. But even here, even though office volume was increasing last year, even here, we've had some price declines. But that actually might be one of the reasons why you've had some office volume, because suddenly you're seeing people meet the demands of buyers, that the market is starting to unwind from this excess period of ultra low interest rates. And if we look at the industrial sector, same kind of story of looking at the individual deals and how it's much more noisy, and then it's almost like a set of Bose noise canceling headsets for prices, and kind of stripping the noise out and just showing you what the trend is, getting a clear signal. But industrial prices, they're down a little bit from the peak in the low interest rate period, but only like 2.5%, 3%, and that's nationally and in Milwaukee. I mean, compared to other asset classes, the industrial sector is the one where pricing is not the kind of problem that it is for the rest of the sector. This is a big issue in the financial world. If you are an asset manager for across multiple asset classes and stocks and bonds and maybe some private equity, your real estate holdings is maybe 10% of your portfolio if you are a little bit more exposed than others to that. So when you hear real estate is having trouble, because you read the Wall Street Journal and you see all this office stuff, you're thinking, oh, all my real estate is a problem. But that's not the case. All real estate is not the office market. The industrial market increasingly is the biggest driver for a lot of institutional players, the biggest driver of their portfolios. They're pivoting out of offices at this price. Maybe they come back later when it's been reset to a new low level, reflective of the risk of the CapEx involved, reflective of the uncertainty of the tendencies there. But all real estate doesn't have the same trouble that the office sector does. Industrial seems like it's adjusted to some of the high interest rates and the changes. We'll see if it continues at a good pace and if it leads to a nice steady pace of deal flow in the future. But it doesn't have the same problems as the rest of the market. The problems in the rest of the market, though, are leading some people to become excited. They see distress. They have the memory that after the financial crisis and the big price declines, that there was all these folks just coming out of the woodwork running distressed situation funds and trying to make some money there. I think there's going to be some opportunities in that, but it will be different this time through. I think it's going to be much more in favor of private local buyers this time. So here's why. If we look at the deal volume, the distressed asset sales that are out there, or rather, the outstanding distress, and meaning it's in a delinquency period, somebody's not paying their loan, somebody's having some trouble with it. The office sector's where the big problem's at. Potential distress, that's a trickier one to quantify. Most of that potential distress, we're getting that mostly for the CMBS market, and because assets enter a watch list, it's not fully delinquent yet, but like the apartment market is the biggest potential distress situation because the GSEs and regulators are watching closely, understanding that prices are falling in some of these markets, and just lining up the assets and saying, if the asset price falls as much as the market price, given where the loan was at, they're going to put some equity into this to keep this alive. So maybe it becomes distressed in the future if they don't want that to put more money into it. It's not to say it will go bad, but there's more of them that might go bad. So it's gotten out of like, again, potentially distressed. But the apartment market is a big one there. But it's also a function of just the apartment market is just so freaking big. It's the biggest investment market in the United States now for commercial real estate by a wide margin. So some of it is just a scale issue for apartments. But the biggest sources of distress are retail and office. And part of that, part of that exposure is also just a function of the challenges of those sectors. It's not, it's fundamental distress this time. It's different than the distress that people dealt with after the financial crisis. After the financial crisis, people dealt with the distress. It was a financial distress. It was somebody who bought an otherwise cash-flowing office building at a 95% LTV or higher, thinking that rents would continue to grow at a double-digit rate forever. And guess what? That didn't work. So it was effectively a bunch of suits from New York flying in, taking possession of a couple assets, putting a new capital structure on them, doing very little with the asset, and then flying back and selling it a couple of years later for a big capital gain when the debt markets opened up again. I'm oversimplifying it, of course, but that's kind of the business model. But that won't work this time because the distress that's happening, it's a Class B office building in San Francisco where there's junkies out in the street in front of it, nobody's in the building, it needs all new mechanicals inside, and nobody wants to put the money into that. So it's not that kind of financial situation of changing it. The retail, it's that dead mall outside of Cleveland with the burnt orange tile and brown carpeting from the 70s, and it needs a tremendous amount of capex. And then all the manufacturing workers who lived around it in the 70s and 80s aren't there anymore because those jobs aren't there anymore. So what do you do with those kind of assets? It's not institutional money coming in and taking a big risk, because they're more risk averse. They want, to them, real estate's more like a bond. They want something predictable. So the folks who are going to make the most out of it this time, I think, are the local owner operators. It's the folks who know how to swing a hammer and know how to work with their local zoning officials and get approvals. So I think it's going to be much more of a private market this time. There's not to say there won't be financial opportunities. The apartment market in particular is, again, it's the biggest component, but I think it's concentrated in some of the biggest apartment markets. There are a lot of stories about the syndicators raising money on social media and putting it to work, buying Class B apartment buildings at 3 caps. That's not going to end well. But that's the kind of stuff that maybe there's some financial changes there. But again, it's going to be concentrated in certain types of markets. I'm just looking here at market by market where the potentially distressed assets are, and this is mostly an apartment story. It's the New York boroughs where I live, like Brooklyn, Queens. It's LA, Chicago, Dallas, the biggest apartment markets. That's where that potential distress is at. And it's still nothing at the moment like what we saw during the financial crisis. I'm looking here at the count of foreclosures every period. And in 2010, 2011, we had hundreds of foreclosures every year. Not so today. Still too early. The office market started to pop up a bit in 2023. I think the other story here is that you're starting to see things move where it never even goes into the foreclosure process. It's a lender and a borrower actually talking to each other like adults and saying, hey, this thing didn't work. We're not going to fight it. We want to go into a managed sale process. We just need to employ a broker, find the most value we can for the asset, because there's no point in fighting you to try and hold on to this. And so some lawyers I've been talking to are actually kind of perturbed because they're cutting them out. They're thinking, hey, there was distress. We were expecting we'd make a lot of money, but now we're not. So it's just not paying off for us to have a distress market like before. But I think that's a key story that people have to think about, that what we're going through is different than before. There is distress. There's, like here for the office sector, for instance, the cumulative distress is approaching the levels we saw in 2010. That's the troubled is, it's in delinquency. The light blue, which is assets now held by banks, it's approaching the previous levels. There's probably more coming. But the way you get out of it is going to be different this time because the fundamentals of the assets are different. So with that, I wanted to just get into some issues around what happens to the fundamentals of the assets. And we'll close with some thoughts about looking forward. Here's the thing. Getting into the office can be a pain sometimes. When you send everybody home and let them work from home, that was effectively a pay increase because the cost of commuting was lower. And so the question that everybody's been focused on, are people going to come back to the office? I think a lot of the analysis there has been wrong. A lot of it comes from HR teams doing surveys and ask people, do you want to come back to the office? And everybody's like, no, I want puppies and ice cream. Everybody wants, easy stuff. Do I want to come to the office? For many folks, the answer is no, because if I can do this at home, I save money. If you as a firm want to attract workers to come in, you got to incentivize them. People respond to economic incentives. You pay me more, I live in Dubai and work. You have to pay me a lot more to live in Dubai and work there, but I would. There's a price on it. And so in the urban economic literature, there's been studied for a long time, when people have longer commutes, they tend to demand higher wages. Because you got to compensate them. If I'm living in Chicago and I have to work in Milwaukee, I'm going to want, if I'm not willing to move, but you really want me to be in Milwaukee, I'm going to ask for a bit more so that, for getting on the Amtrak every day and coming back and forth. So that kind of demand, that filters through into the economy. Each one of these dots is a metro area in the United States. You notice how there's an upward slide here? What I'm showing on this axis is the minutes spent commuting every day on average for consumers. And then over here is the average wage. And this is all data from right before the pandemic. And there's an upward slope. In any city where you had a longer commute, you had to pay people more to convince them to get in. And over here where I live, New York Metro, one of the most expensive areas in the country, longest commutes in the country. If you're trying to convince a worker to come in some long distance, you have to pay them a lot more. That's one thing that Milwaukee, here in the middle, has going for it. It's just easier to get around. So you don't have to compensate the workers as much to convince them to come in. It's an easier sell. So just the quality of life here is helping you to some degree. Here's another issue. This is a chart I grabbed from CBRE. I was kind of joking about this earlier about a Class B building in San Francisco with some junkies out front. But that is the case. Crime in certain big urban centers is impacting asset values. When I'm looking here at the count they did of a number of buildings with buildings that have been hit hard with occupancy declines, and the ones in the relative crime scores around the buildings. There's a much higher increase. The buildings that suffered the biggest increase in the vacancy are much more exposed to crime issues. I mean, it's this issue of, it's just like the cost of commuting. If I have to deal with those kind of challenges, trying to get into my building, I feel a little unsafe, I need to be compensated more for that. Maybe I don't want to take that on as a worker. And so I'll try and stay away and I'll go someplace else. And so that's also impacting the fundamentals of these properties. And firms, they've got a challenging situation. They try to attract workers as much as workers are looking for jobs. And if the high quality folks that you want are not willing to come in because the commute's too long, it's too expensive, or it's not safe, then you're going to have a hard time bringing those workers in. For asset owners, for office owners, that's the point I always make. Forget about trying to incentivize people coming in by giving them snacks in the office. I mean, snacks in the office, so what? For every extra minute of commute time, I need an extra $500. You give me a bag of potato chips that's worth $500? No. It just doesn't add up. But the things that they can do that aren't really out of their own pocket are just pressure their politicians to improve transit options and to make cities more livable and allow some of the problems that are out there to be minimized. So, the industrial sector, some of the future issues there. I was talking about the rubber band economy. We have an issue where we saw a surge in online sales in 2020. Everyone was stuck at home, they had to shop there, right? And so what I'm looking at here is the blue line is e-commerce sales as a percentage of total retail activity. And it kind of hockey stick up into 2020. And it's been decreasing at a slow rate ever since. That decrease had some people worried the other year. Like Amazon made a note the other year about how they're rebalancing their industrial portfolio, subleasing maybe 10 million square feet. I remember the business press went all ape over that story. And to me it was like, oh, 10 million out of how many hundreds of millions of square feet that they've got? They're just tweaking at the edges at that level. It wasn't the big story that they thought it was. But we're kind of getting back to a point where if there was no pandemic, we'd probably be around here anyway. And when I think about I think this is important to think about for the industrial sector because for every dollar spent online versus in store, you're using around 3 times more industrial space, just for storage and transmitting goods around. So it's been the big source of growth in demand for the industrial sector. With price growth moderating, with the declines from the peak levels of e-commerce activities to share total, people might be a bit worried about the industrial future. But I don't think we're fully done with digitization of the consumer experience yet. Consumer sales online versus in store is still growing at a much faster rate. It's hard just to kind of change those numbers overnight. There's a generational change as demographics of people who are just more used to shopping in store start to age out of the economy. It's probably a light euphemism, but it's almost as if the trend that we're starting to slip into now is almost as if what we would have seen if there were no pandemic, which is probably a bit hopeful. But the last thing I want to close on is just some thoughts on capital markets. And I was kind of joking earlier that everyone in the room is too young. But even this chart is, I'm too young to really have experienced it. But we're going to be facing a different environment moving forward than what we've been dealing with in our careers, in all of our careers. Is any show of hands, how many folks here were doing deals in the 1970s? Okay, talk to this person. Because we're moving into an environment that's like what you dealt with back then. And how you survive is going to be different. We had it easy in a sense. From the mid-1980s till 2022, anytime you were buying or selling a building, the interest rate environment you were in was lower than where the previous transaction for that building had been. So the blue line here is a 10-year treasury. And on average in the United States, commercial real estate investments are held for about 7 years. So the teal bars show the change in the 10-year treasury from 7 years earlier. And every time someone went to buy a building, the seller had bought it and financed it in a higher interest rate environment, and now they can sell it at maybe a slightly lower cap rate. The next buyer can probably get a lower mortgage rate than they had. And so you had capital market forces at your back. They were a tailwind. They were helping boost growth in the sector. Even if the 10-year treasury stays at 4.1, stays flat there for the next 7 years, we're going to have headwinds on capital market forces for every deal moving forward. It's going to be like this period in the 70s, where every deal you had, you're trying to buy it from somebody who had a cheaper mortgage in the past and a lower interest rate environment, and you had to do other things to make a deal work. So it's going to be a harder environment for investors to work in, because you can't just buy an asset and have a cap rate change to paper over any mistakes you make in the building. Performance is going to become much more focused on the fundamentals. In a way, when I give this talk to real estate schools and just grad students, I tell them I'm happy for them. They can actually be real estate people now. They're not just going to be financial engineers. You know, the success moving forward is be determined by making sure you got your ground game going well at the asset level, making sure that you've got your CapEx spend managed properly. You just can't spend stuff willy-nilly. You've got to be really diligent about that. It has to be timed just right. You got to manage how the TIs get in there. You really need to work closely with your brokers and really make sure that you have the right leasing in place and you have the right mix of people in there to manage those risks as well. Those kind of fundamentals are what's going to determine success moving forward. It's not going to be as easy as when we had just always falling cap rates kind of papering over any of those kind of mistakes. So, you know, to the extent folks are going to be successful moving forward, they're going to need to talk to everybody in this room. So, again, things were bad in 2023 for deal volume. The big declines in growth rates that people are talking about. This is where you want to take a picture. You can, I think the pandemic did teach all of us at least one thing: how to use QR codes. So, and my contact information is there, and I can send you slides if you want them. But I think the big story is that, you know, we had this decline in deal volume. People were worried about it. It was a decline, but it was a decline from excess highs. And, you know, we're still dealing with the after effects of 2020. It's a slow-moving shock from 2020. We're still seeing the after effects of it, and it's not all. It's not as bad as some of the headlines in the business press will make it out. So, how much? Maybe we went over about 5 minutes or so, but let's see if we have time for any questions. Do we have?
Yeah, we probably have 3 questions. I have a microphone if anybody wants to ask a question. All right, I'll start. We've been seeing a lot of headlines about some turmoil with the banking industry related to commercial real estate. Can you touch on that and what you see in the future, especially for regional banks?
Yeah, last week was kind of interesting on that. There's a whole hullabaloo around the banking sector last week with one bank in particular in their earnings statement highlighted that just 2 office loans that they had. They didn't say where they were, but I think I know where they were. I think there were big office towers in Manhattan. 2 office buildings reduced their whole profits for the quarter. You can only have, at that scale, you know, a small suburban office building in Manitowoc is not going to, you know, have that impact on a big global bank that way. It's just the dollars don't add up the same. And so all banks, though, suffered in the stock market because they weren't, you know, all the hedge funds were struggling because they're thinking, oh, well, all real estate's bad, so anybody who has exposure to real estate, let's ding them. But this is something I've been telling our sales team. We have a whole sales team focused on selling stuff to hedge funds. And we're trying to convince them, sell them our data about the exposure of every bank to different industry sectors. Because there are some small banks that didn't have office exposure. You know, so they're not going to have the same kind of troubles as the folks who are making big office loans in downtown LA, in Manhattan, and San Francisco. So there's probably more risk focused on those big banks that were doing those kind of loans. I'm not sure the market's fully priced that in yet, but I'll let the folks in the hedge funds figure that out.
Economists over the last year have been predicting a soft recession, and interest rates are told they're going to go down, not go up again. What are your predictions on that?
Yeah, this, you know, normally I'd repeat the question in case anybody couldn't hear. Everyone heard that. It is kind of funny. You know, people have been calling for this. It's the recession that never hit. And if we have a soft landing, it'll be remarkably engineered. There are still challenges out there. Jay Powell's been out there highlighting how we are on an unsustainable fiscal path with debt growing faster than the economy overall. Something's going to have to give. But do we hit a recession? If this is a downturn, bring on a downturn. I mean, if we have anybody who wants a job can find a job. There's some challenges in that. Maybe people have to redeploy. If I was leasing only office buildings and doing nothing else, maybe I have to redeploy and retrain a little bit for some other sectors. Maybe there's less demand there. But there's still demand for the folks. There's still demand for the skill sets, for the social capital. It's where I think things are hardest hit are the companies that were really dependent on free money. And this is happening even before the recession. This wasn't just, even before the COVID crisis. There was this impact from the free money period from 2009 on, where firms were willing to engage in a business practice called blitzscaling. This is mostly the tech world, right? Everybody saw Amazon, everybody wanted to be Jeff Bezos. I mean, who wanted to have their own private rockets and fly around like that, right? But the way they made so much money was by gaining scale first. Once they had scale, ring-fence industry, then they got profitability. So every VC startup followed that blitzscaling business model. They weren't delivering profits. In fact, they were issuing additional rounds to raise more money and burn through that. And you had a tremendous amount of growth and hiring and spending going on in that tech sector and leasing of office space in that tech sector, because they were all willing to throw good money after bad for a while, just trying to get that scale. That's over. Those firms now have a growth requirement. And so they're not spending with that wild abandon. They're also starting to cut back on some of that labor. Is that enough to lead to a recession? I don't know. I think some of those folks maybe will find other jobs in other places. Anybody who wants to work in construction, I've got a place in Florida, like a winter place, and doing some roof repair work. You can't find roofing people anymore. It's like there is nobody available. We have some labor shortages in certain areas, in certain sectors, and over time, wages will adjust and get the people in there. But that's the one area where I think the folks who were heavily dependent on the free money period, you may have kind of small regional recessions, maybe pullbacks in certain markets based on that. But that wasn't enough to drive the whole U.S. economy overall.
Anyone else?
Well, and if you have a question later, you're driving home and you realize, I should have asked this. There's no details, so I'm always happy to chat.
Perfect. Thank you so much, Jim. We'll
Thank
share
you.
the slides, and I think we have an audio recording that we'll try to, hopefully it's not catching all this stuff, but thank you so much.
Thank you.
Enjoy the rest of your time. And thank you to our sponsors, Rock County and Coldwell Commercial. Really appreciate your support. Thank you. Have a good day, everyone.